Hi there, this is Ali Salarian, broker at REMAX Success Realty, and I'm back to you again today to talk about the inflation rate trend so far in Canada and what's the expectation for the next Bank of Canada meeting in December of 2024, whether it's going to be a slim cut, no cut, or a jumbo cut, as everyone is talking about. Let's dive deep here. So, I'm going to share with you to start with the news. In Toronto Start days ago, they were talking about inflation rises to 2% in October, putting size of December interest rate cut into question. Previously, I was talking about that if the inflation rate is going to go up, not down, or is going to go down, not up. So let's see how which direction is going to go. Let me just share another thing with you, which is from July, the inflation rate trend all the way till October, it was 2.5, then 2%, then 1.6, then 2%. So the problem here is not inflation rising, is deflation. So when we hit 1.6, I was worried myself as the Bank of Canada governor and his team were worried about to heading to deflation. And deflation is as bad as inflation, might be even worse. Deflation, when you go the growth or a CPI or the inflation is going to be minus or close to the zero, which makes the assets, any assets goes negative toward negative, and it's going to be really really tough to get out of it. An example of that, Japan was in that problem for years and years and years. So that's why the Bank of Canada was cutting the inflation rate in a way to very carefully to keep the inflation between, let's say the target was 2%, but they were aiming anything between 3 to 2%. That was what the Bank of Canada plan is. However, don't think that once you cut the interest rate or you keep the interest rate, and even if you keep if you even if you hit 2% and you don't change the interest rate, it won't stay month over month same way, because month from month the consumer behavior is different. I'll give an example. We are heading right now into holiday season, and holiday season is well known in Canada or North America or most the Western country, is a season where people spend or overspend money by traveling, buying each other gifts, going to restaurants, relaxing, and all of that. So in one word, people are not going to work, relaxing, taking vacation. Another word means they are spending more money because they are at home. They can't resist. The humans, consumer in the Western economy, they can't resist. See, during this season, especially when you have a Black Fridays coming in, Boxing Day, and too many, and Christmas Day and holiday season, all discounts, everything online or in store available for the consumer in Canada, cannot stop themselves to buy. So definitely the CPI is going to go up. But that's for sure. Now, 2% for October. This is what we this is what you see. This total CPI is 2%. Is that 2% is going to go higher or lower? In my opinion, is the inflation is going to go higher for two reasons. Reason number one, because of the holiday season. Reason number two is this news came up recently here by the government of Canada, the federal government of Canada. Uh, I think the prime minister came on news, and the minister, Stephen, of the, I think the economy minister, came and talked about 2 months break starting, I think, from December 14 or 15. I'm not sure exactly the date. 2 months of break on the HST, which is the GST part of it, which is federal, on some goods and services, including grocery, kids' clothing, gaming, like a lot of item here. I can't tell you, like at least here, children clothings, children toys, foods, restaurant meals, snacks, beers, wines, books, printing, newspaper, Christmas trees. The only thing is missing in the list is, I think, when you flights and tours and everything. So this is a huge and big break on the GST part of the HST, which would The question is, would it make the consumer to spend more money or not? And knowing that it is temporary. Now, do they would they spend more money? Would that impact the inflation? In my personal opinion, yes. Would that be I mean temporary or permanent? In my opinion, is going to be a temporary because it's only for 2 months. Would that take the inflation rate up more than 2%? In my opinion, yes. I don't think we're going to see 2%. Probably it's going to be 2.2 or something like that heading December and January. So that makes the Bank of Canada mission to cut or do not cut or slim cut or jumbo cut really difficult. But remember one thing, there is nothing, again, back that I'm repeating the same thing. The interest rate cannot, in my opinion, in future cannot be kept steady, kept no change for a long period, because you have to go along with every and each month. That's why the variable, in my opinion, is the best rate to go with if you're taking a mortgage. So question is going to be any cut or not? In my opinion, yes. But would it be 50 bips or 25 bips? Before this news to come out, I was really seriously thinking of another 50 bips because the inflation from 1.6 to 2%. But now, after this, I think they're going to take break and take slimmer cut, which is 25 bips. That's my prediction. I was predicting 50 bips, but now I think they're going to go 25 bips, making themselves ready for this break on the GST by the federal government in Canada. What that translates into real estate and mortgage, it is very simple. The more cut we have in the Bank of Canada overnight rate, the more we cut we have or reduce we have on the interest rate, which is variable. Or I know some many banks, they did not change the fix. I'll tell you why right now. And that will gonna impact the real estate at all, because the cheaper money that you have, the more buyers you see them in the market. Already we have a lot of buyers in the market. Every realtor know about that, especially 1 million more or less. It's huge movement nowadays. In some market, I was, for example, Thunder Bay market, I was doing some transaction. They have two problems: lack of supply. I would say the most market has a lack of supply and big demand. Anything comes goes in matter of days. And this has all recently happened. The reason why, because of the interest rate cut and cheaper money available for the buyers. Now, why the fixed rate is not getting reduced significantly the way people are expecting? Because if the Bank of Canada cut 50 bips, then the fix has to go down as the variable is. First of all, fix is not like a variable. Fix is where the banks decide on what rate, and that decision based on multiple things. Let me explain the compound of an interest rate as a former banker. So any interest rate has a compound as the cost plus the cost is two. There is a direct cost, which is Bank of Canada rate, or the cost of borrowing, where the deposit, because the deposits coming from depositors. What's the cost of that? Then you have the margin, which is two compounded margin. One is the management cost, one is the risk factor cost. So let's say deposit is available for, let's say, 3%, and then the bank will take that 3%. That is the cost of the deposit from depositors or from banking channels. Sometimes smaller bank, they take it from big banks, and big bank take it from depositor. Then they add a margin. Now that margin depends on two things: the management cost. Now management cost more or less is not is kind of fixed. Is not, it depends from bank to bank, but it's mostly fixed. What is really changes in the that margin is the risk factor margin. The risk factor depends. If you go back 2008 and 7, during the credit or liquidity challenges, or we had back, it was a global problem. So the interest rate was down, was low, but the lending rate was high. The reason why, because there was no liquidity. A lot of company, they were going bankrupt, and problem in the economy overall the globe. What the bank did, because of course, unemployment, they found the risk is high, they increased their margin. So the margin back then was 200 bips, 300 bips, 250 bips. I remember that high was up to 300, 300 bips. So seems the banks are taking step by step the same measures because they are seeing unemployment in the economy. Yes, the Bank of Canada focus is to curb the unemployment and bring it down to at least 4.5, like what it was before. But it takes, in my opinion, a couple of quarters, at least by the second quarter of the next year. So what the bank doing right now, they're putting their fix with higher margin. The reason why, because of risk factor of the economy, especially in the unemployment. Now, on the top of that, we have other news which happened a couple of weeks ago, which the U.S. election. Yes, it might have impact on Canadian economy. At the same time, not that severe impact. Nobody knows what's going to happen with the tariffs, which is expecting to be imposed on Canadian goods and services, with that impact on the economy and all of this. In my opinion, Canada is a big trade partner in line of US. No matter you hear the politics, whatever they say, in the reality, they won't do it because it's going to be a loss for both parties. So a lot of things, a lot of variables happening in order to predict the next move of Bank of Canada, but definitely is going to be a cut, in my opinion. Whether it's 25 bips or 50 bips, let's see based on the what's happening. So production is probably 25 bips because of the new Fed break on attacks and the news coming from US. That's another reason. Let me put it this way. So it's going to be, in my opinion, probably 25 bips. Although Bank of Canada want to do it faster and bigger cut, that's their target is. But let's see. Let's see. We don't know. But the good news, there is a cut. I mean, one stop cutting. They want to hit their target, which is, I believe, 2.5 or 2.5, the overnight rate by end of 2025, which is if you add another 100 bips on it. So the variable should be available at 3.5, which is going to be half of what we reach at the peak. So imagine whatever you pay in terms of interest is going to be down by half. Big relief for the Canadian, and most of that a lot of mortgages getting renewed by mid of next year, and they want to avoid that, like big problems going to happen. So I think by mid of this next year, they're going to be Bank of Canada going to be at 3.5, meaning variable 4.5. But remember, if somebody comes and renew from 2.5 to 4.5, you're talking about almost doubling. So that's another hit for the renewal of the mortgage. Would that increase the supply? In my opinion, yes, because right now there is a supply issue with that, but the buyer is still going to be going on. Yes, nowadays market is moving, but we have supply issues. Example, some market like Thunder Bay is very tight. Some other market more and less. Some market like London, Ontario, for example, I have seen it is still in coma, is not moving. I believe there are a lot of supply out there. It depends on the market. How many? The biggest factor in each and every market are the number of investors. If you are in market, you feel a lot of investors bought houses around because whatever reason, you got to know that that market, it won't recover that fast. If you are in a market less investor, more principal residents, that market is already recovered and doing well. Thanks for listening, and that was the news I wanted to share with you. Stay tuned for the next news and have successful real estate.